All right. Well, good afternoon, everyone, and welcome to one of our analytical corners on debt at risk. My name is Natalia Venegas. I work in the communications department, and I'm very excited to be here with you today. Before we get started, I do have a couple of housekeeping points just to ensure that our session runs smoothly. So first, please silence your phones, sit tight, because this will be exciting. To begin this presentation, it is my pleasure to first welcome Seira Ogata, Secretary of the IMF. Please welcome him.
Thanks. Good afternoon, and a warm welcome to everyone. We are back again at the spring meetings, and I think you will agree that they are taking place in the face of several pressing global challenges. We have persistent, slow, and uneven economic growth, increasing debt vulnerabilities, and a realignment of global trade. Our finance ministers and central bank governors are here to reflect on where we are and where we are headed. By their very presence here, they recognize the IMF as an institution that is able to bring together key policymakers and other stakeholders to tackle the challenging economic issues that we are all facing. This is no small feat, and we should not take it for granted. We, all of us who care about multilateralism, have to constantly show the value of multilateralism. And as part of the work of upholding multilateralism is our rigorous research, sound analysis, and policy advice. And to that end, I am delighted this afternoon to introduce some of the best research in the IMF. Over the next 2 days, you will hear from our talented professionals, many of them young professionals starting their careers at their fund, who are working hard to shape the future of policies through their research. All the presentations I think you'll find are topical, focusing on key topics such as financial stability, debt, market access, and population aging. There is something for everyone. I encourage you all to attend as many sessions as you can and to ask questions or make comments. Thank you, and best wishes for this year's spring meetings.
Thank you, Seira. All right, so now it's my pleasure to welcome to the stage Faison Guizot, who will present for 10 minutes, followed by 15 minutes for your question. So let's welcome Faison.
Thank you.
Take it away.
Global public debt is high, rising, and risky. It exceeded $100 trillion, which is around $12,500 for every person in the world, or 92% of GDP in 2024. Debt levels are projected to keep rising, as shown by the orange line here on the chart, and approach 100% of GDP by the end of the decade. Looking forward, increasing trade uncertainty, elevated geoeconomic uncertainties, spending pressures, for example, related to defense, and tighter financial conditions could further complicate the debt outlook by depressing growth and increasing fiscal deficits. History also tells us that debt can increase unexpectedly with quite painful economic consequences. Good afternoon, everyone, and I hope it still is one. After that rather somber opening, I'm very happy to be here. It's a full house, which is great, to present Debt at Risk, which is joint work with my IMF colleagues Davide Forcieri, Domenico Giannone, and Raphael Lam. Debt forecasts are usually expressed as a single value for a particular country or country group and year. But given what I just told you, studying the risks around the debt outlook is quite critical. So, how do we go about doing this? How high could public debt rise in a severely negative economic scenario? How have debt risks evolved over time, and are there differences among countries? Do rising debt risks portend economic and financial difficulties to come? We answer this question by developing a novel debt at risk framework. Put simply, the framework uses information on economic, financial, and political conditions available today to assign a probability to all potential future paths of public debt. In other words, how likely is it that debt could increase to 110% of GDP, or 120% of GDP, or even lower at 50% of GDP, or any other number that you can think of? We find that in a severely adverse economic scenario, global debt to GDP could exceed 115% of GDP, which is the purple dot on the slide. This level of indebtedness has not been seen since World War II and is around 20 percentage points of GDP higher than current projections, which is the gray dot. We also find that our measure of debt at risk is a strong predictor of an oncoming fiscal or sovereign debt crisis. Tackling these risks should therefore be a priority in many countries. Let me tell you a little bit about our approach, which follows 3 steps. First, we use quantile regressions. We estimate quantile regressions using annual data from 47 economies covering more than 90% of global debt. The variable we're interested in predicting is the entire distribution of the debt to GDP ratio 3 years into the future. And the 8 variables we use to create this prediction include economic variables such as primary balance and growth, but crucially, also financial variables such as an index of financial stress and sovereign spreads, and political variables such as an index of social unrest. These quantile regressions allow us to construct predicted percentiles of the future public debt to GDP ratio. And we define debt at risk as the predicted 95th percentile, which is the level of debt where there's only a 5% probability that debt would be higher than that level. In the second step, the predicted percentiles that we get from the quantile regressions are fitted to a density function to get a full probability distribution for each country or country group. And then in the final step, we combine densities based on these individual 8 predictors into a single distribution based on the most important factors that drive debt risks for a particular country or country group. Our main finding is that debt risks are increasing and tilted to the upside. As shown on the left chart, the orange line, global debt at risk has increased quite consistently since 2009, mostly mirroring the path of debt to GDP itself. However, as shown in the right panel, upside risks to the debt outlook, which we define as the difference between the predicted 95th percentile, so the debt at risk, and the predicted 50th percentile, which is the median, are also consistently higher than downside risks to the debt outlook, which are defined as the difference between the median and the predicted 5th percentile. As you can see on the right chart, upside risks spike noticeably during periods of global economic shocks, such as the global financial crisis in 2009 or COVID-19 in 2020. And the reason for this finding is that most of the predicting factors that we use have disproportionate effects on the right tail of the debt distribution, so the bad outcomes, the bad debt outcomes, as opposed to the left tail of the debt distribution, which would be the good debt outcomes or the good debt surprises. So, which of these factors are currently driving debt risks? We decompose the effect of each of them and find that currently, the primary deficit and financial conditions, which is an index of financial stress or higher sovereign spreads, are currently the 2 largest contributors of the 20 percentage point gap between debt levels, projected debt levels, which is shown in the green bar, and our estimate of debt at risk, which is the orange bar. The result is important because it tells us that the primary deficit is an important lever that can be used by policymakers to not only bring down debt levels, but also lower the associated debt risks. Debt at risk also differs notably between country income groups. For advanced economies, our estimate of debt at risk, which is greater than around 130% of GDP, has declined since the pandemic and is near its average over the last 15 years. In contrast, for emerging market and developing economies, while the estimate of debt at risk at a little bit more than 95% of GDP, while it's below that for advanced economies, it has actually increased over the last decade. Consistent with existing research, we also find that while economic and policy uncertainty are larger drivers of debt risks for emerging markets, financial conditions matter more for advanced economies. So, beyond this quantification of debt risks, which I think is valuable, does debt at risk have any additional value for policymakers? We answer this question by looking at the relationship between debt at risk, or our measure of debt at risk, and fiscal crises. And we find that our measure of debt at risk is a very strong predictor of these crises. And we show this finding in 3 ways. First, upside debt risks on their own are positively and strongly correlated with an indicator for an oncoming fiscal crisis. Second, even after we include additional variables that are commonly used in the literature, such as debt levels or debt servicing costs, so the interest bill, we find that our measure of debt at risk should always, in a probabilistic sense, be included in the true economic model for predicting a fiscal crisis. And third and final, relative to these other predictors, our measure of debt at risk has one of the highest variable importances, so in other words, the highest predictive power when it comes to predicting fiscal crisis relative to these other variables, as shown by the orange bar on this slide. So having presented this admittedly gloomy outlook, what is the policy bottom line? Well, amid rising and risky global debt, decisive action to bring down public debt is now overdue. A gradual fiscal consolidation could, in this sense, help bring down projected debt levels, but also crucially lower debt risks. The adjustment needs to be country-specific, tailored to a country's own circumstances, of course. Moreover, fiscal policy can actually act as a tool to promote growth and thereby mitigate this kind of trade-off that we have between boosting growth and lowering debt. And then finally, policymakers can use the debt at risk indicator to monitor signs of fiscal or sovereign stress in their economies. A canary in a debt-ridden coal mine, if you will. Thank you so much for your attention, and I look forward to the Q&A. Thank you.
Thank you, Faizan. That was truly amazing. And this is a beautiful crowd. Now we do have questions. We have time for your questions. So we have a colleague with a mic in the room. If you have a question, please raise your hand. And remember that when asking your question, state your name and your affiliation. So let's dive in. Okay. Please raise your hand if you have a question. I see one. We're going to take around 2 to 3 questions, and Faizan is going to answer them. Please.
Hello?
Yes.
My name is Dapel from Northern Gas. I'm interested in knowing your perspective to the link between regime changes and rising debt.
Any other question in the room? Okay, I have a question over here on my left. Please raise your hand and keep it raised, please. See over there. Okay, please go ahead.
You outlined, this is Varun Gosai from Constellation Capital Management. When you look at debt to GDP, you have a pretty gloomy picture. But if you look at debt as a percentage of total assets, because total assets to GDP has been going up probably at a much higher rate, maybe one doesn't get as worried. Do you have any sort of thoughts on that?
And we'll take one more. Yes, here in the middle.
Okay, there we go. Ethan, and I'm affiliated with George Washington University. I wanted to ask, what are your thoughts on how government debt is contributing to growth in the private sector as well?
Want to take another one? Or?
No, so yes.
All right, please.
If I forget any of them, please
I'm
keep
right
me
here,
honest.
yes.
So I'll just answer them in order. To your question around regime change, I think while that variable is not directly included, one thing to note is we do look at, which we think is one of the big value adds of our work, is looking at political factors and their impact on debt risks. So if the regime change episode would create an increase in a social unrest index or an economic uncertainty index, which are both incorporated in our model, which I would expect that would happen, then that should be factored into our model indirectly, in a way. So I think including specific variables would be beyond, I think, the scope of our work, but we already look at the effect of political factors in how we monitor the evolution of debt risks. On the question of debt to GDP, I mean, I think there are many definitions of how we would size debt. In general, when we have looked at, we obviously just can't use the nominal amount of debt, so you have to scale it by something, and especially when you're thinking about creating a country-consistent framework. And we find, because we really want to extend this to have global coverage, that having debt to GDP is a variable that is consistently available across many economies. So right now, the results are for 47 economies, but in the working paper that we hope to publish soon, we have extended the analysis to 175 economies. And I think when we do that, GDP is going to be available, but assets will be a bit harder to do. And then on the last question, I think one of the reasons why high government debt, so obviously this presentation is about government debt, high government debt is the problem is that it crowds out investment, and public and private. And so I think that is one of the links that is pretty clear when we think about what happens when the interest bill on your debt grows, which normally tends to happen when debt is quite high, especially in some economies. So I would say that is one of the ways to draw the link. And in some ways, because we're looking at the future debt path relative to current conditions, if that happens and growth actually goes down, then that should be reflected in a higher debt at risk as well.
Thank you. We have more questions. I see one over here. Please remember to introduce yourselves. Thank you.
I'm coming from York St. John University in the UK, and I'm Gabriel. I get the impression that your research is advocating against debt. But when we look around the world, it's obvious that there is so much development that needs to be done. So if debt is bad, what is the alternative? Thank you.
One question here in the middle. Yes, please.
Yes, good afternoon. I'm Jean-Paul Njemba from Malta Capital. You know, we as a firm, we landscape the continent, African continent, advising governments. And we are seeing that a lot of the governments in Africa, they have foreign currency debts, you know, some of them SDR and so forth. And we are realizing that, you know, the extra cost of that debt, a lot of it's due to, you know, FX, like fluctuations. Right? A lot of it is due to commodities pricing fluctuating or interest rates, you know, fluctuations. And the feeling we have is we are not seeing the emphasis of, you know, a lot of organizations, whether it's IMF or World Bank, about the need for these countries to hedge, right? And, you know, there are a lot of factors that obviously they are not controlling, right? That nobody actually controls. But, you know, not hedging is already making a decision, right? And I just wanted to have your thoughts on if you have made the analysis on, okay, there is the cost of debt, the burden, but how much of that is due to the fact that countries are not hedging their, you know, foreign currency loans, they're not hedging the interest rates fluctuations and so forth. Thank you.
We'll take one more question right here. Oh yeah, over here in the...
Samuel Sule, Renaissance Capital Africa. We acted as advisor to the regional group on the Ghana restructuring of recent. I think the question, I really wanted to understand your key findings when you back-tested this, because it'd be interesting to see how prior crises that have happened, how it fits into your model. And the second thing is, I heard you said you would be publishing on a country-by-country basis. Is that the case? And if that's that would be good to see. Any findings from that? Thank you.
I think we're good.
Okay, so thanks. So on the question of debt is bad, I don't think the intent of the exercise is to advocate for debt being good or bad. I actually think what I said in the opening is that when, and this is a historical fact, when debt increases unexpectedly or reaches a certain level, which is not the same for every country, of course, that can lead to a very painful macroeconomic adjustment. And we've seen this over and over again. And so before this point, to the best of my knowledge at least, there hasn't been a consolidated analysis thinking about how high could debt go in a really bad economic situation. And does that actually have meaning in that does it predict a fiscal difficulty or a sovereign debt difficulty to come? And so the fact that we're able to do it suggests that monitoring these upside risks, similar to how growth at risk is produced here at the IMF, or even more broadly, value at risk is produced in the finance literature, is a way to really keep track of debt risks. Are they really spiking? Are they moderate? Have they moderated since COVID and so on, using the trends that you can look at in the data? So I think that's really the big purpose of our exercise. Second question was?
Second question, foreign currency.
Oh, yes, foreign currency. Yeah, thanks. So I think on that one, at this point, we have not included currency composition of debt, and hedging is a step even more beyond that in our analysis. And again, that's a data availability issue. If we want to have a database that is annual, which is still not as high frequency as some of these other measures of at risk, like growth at risk, we would like to have as broad of a coverage as possible. And so I think currency composition data, again, compared to just gross debt to GDP, is less widely available. One thing that I'd like to stress, and I was going to stress at the end, but I'll say it now, is the way we've developed this tool is that it's quite flexible in that it can accommodate additional variables without oversaturating the model. So normally when you have any model and you add in more variables on the right-hand side, that just oversaturates the model to the point that you're just improving in-sample accuracy, but out of sample, it's not very helpful. But because the way we compute the weights to combine distributions are, it really depends on how well any particular variable does in fitting the debt distribution, you could flexibly add more variables that are more important for your country or region. So we really hope that this is kind of the first step in thinking systematically about debt risks. And if certain factors matter more for your region or economy, then by all means, you should do that. And then the third question?
Country basis.
Oh, yes, on the country-by-country basis. So on that one, we do estimate debt at risk for these 47 economies. I'm still not clear on what the replication packet is that we will publish, but we will try and publish a replication packet with the data so that those estimates are available. Oh, yes, thank you. It's a good point. Actually, I was going to make this point when you raised it, so I'm glad you brought it up. So there are two things we did to backtest, which I think are meaningful. The first thing we did was we said, is this 20 percentage point even reasonable? Am I just estimating something really big that has never happened in history before? And even at the global level, we find that the 20 percentage points in percent terms, not percentage point terms because debt is a stock variable, it's around how much debt went up by during the global financial crisis and during COVID. So when we think of a severely negative economic scenario globally, I think of those two, and we seem to track. That's one. The second thing we did is we looked at, because we predict the median, the 95th, and so on, does the median track, the predicted median in an out-of-sample setting, does it match the realized debt level, assuming that on average you should be close to the median when countries, and we actually find an R square, so like a goodness of fit of more than 95% when we did that. So I think that because of those two methods, I'm fairly comfortable with the methodology. Yeah.
Okay. So we're running out of time, but before we wrap up, Faison, I do have to give you the final word and ask you if you could say, in a tweet, what is the key message of your presentation?
Yeah, thanks, Natalia. So I gave it away a bit earlier, but I'll say it again, which is to say that monitoring debt risks is important, but we have developed a framework to think about this, and while our work stands on its own, we really hope that this is the first in many exercises to systematically think about how debt risks should be viewed and evaluated. And so if you think that, and our framework is flexible enough to incorporate additional variables or even higher frequency data. So if you have quarterly data or monthly data based on your own internal databases and you want to apply a methodology, you're welcome to do so. So we really hope this is the first step in ongoing and future research on debt risks, and we're happy to collaborate on any of those going ahead. Thank you so much.
Great response. Thank you. So as I told you all in the beginning, this was going to be great. I want to remind you that we have another Analytical Corner session just like this one at 4:30 p.m. in this same room. And again, want to invite you all to all of the events that are taking place over the week. Thank you again, Faizan, for being here. Thank you all for being here today, and have a great rest of your day.
Thank you.